Fast fact: money lending can be traced back to about 3000 BC in ancient Mesopotamia. Before currency was widely used, ancient peoples used food as a way to pay their debts. With the promise of harvest, in the spring, farmers would borrow seeds and then share their crops to pay their debts. I'm Drew Thomas, and you're listening to Bank Chats. Today we're pleased to have with us Senior Vice President of Retail Lending at AmeriServ. His name is Rusty Flynn. Hi, Rusty. How are you?
Good, Drew. How are you?
I'm great. So tell us a little bit about yourself. Tell us a little bit about your background.
I've been lending money for 32 years. I started with a finance company for about 7 years, and then over the last 25 years, I've been in community banks, the last 17 with AmeriServ.
So 25 years in community banks. Yeah.
It's been a long time.
So we're going to talk a little bit about consumer lending today. When someone comes to a bank to ask for a loan, where does that money come from exactly?
The vast majority of our money, our funding sources come from our depositors. So we take in deposits, whether it's checking accounts, savings accounts, CDs. Generally, what we do is try to turn that money into lending opportunities, and the difference between what you lend out compared to what you have on deposit, that's how we make our money. One of the simplest sources of how banks make money over a period of time. So banking at its simplest sources really comes down to interest revenue, fee income, or investment income. So when it really comes down to it, what we're trying to do is take loan interest, what we get on our deposits, lend it out, and the difference is interest revenue. So that's really what it comes down to, is a simple source of use our own funds to make money.
So theoretically, I come in and I deposit, we'll use vague numbers. I come in and I deposit $1,000. And I could take my money back anytime I want, correct?
Correct.
All right. But at the same time, you're using some of my money to lend to other people to generate interest, is what you're saying, right?
Absolutely. I mean, we're pulling everybody's money in there to generate income for everybody that's involved in the process.
So it's not that the bank has all this money, right? We're just holding that money and then reallocating it out into the community.
Yeah, absolutely. I mean, we're reallocating it, and the bank has other funding sources too, lines of credit that we have to cover sources if we would happen to need it, overnight borrowing from the Federal Reserve and other lending sources. But generally speaking, our first funding source is our deposit base.
Okay. All right, so that makes sense. So I think a lot of people have the misunderstanding sometimes that the bank is just full of money, and that we just give it out to the people we like the best or something, and that's not really the case. It's the depositors that we have that give us the ability to lend that money back out.
Yeah, absolutely. I think everybody has a misconception that the vault has piles and piles of cash that we're just ready to give out. So there's limited sources of actually cash on hand, but at the end of the day, we're trying to lend out what we have on deposit.
Okay. All right. Well, that makes sense. So what kinds of loans would you say? Like, what's the difference between, for example, a secured and an unsecured loan? Maybe we just start there.
I'll start on the simplest ones. The unsecured loan is just a personal loan that somebody might take out, shorter term. It's a term loan. A term loan just means you're taking out a fixed amount of money at a fixed interest rate, paying it back over a period of time.
Okay.
So if you want to take out $5,000 over 36 months, your payment's going to be equal over 36 months. And once it's done, it's paid off. You're down to zero. The loan is gone.
Okay.
So a line of credit, on the other hand, is it's a fixed amount where the bank's going to say, Drew, you come in and you apply for $10,000. So think of it as a credit card. But it's a line of credit that you can use over and over again. You're only going to pay interest on what you borrowed at any one time. Pay it off. You can use it again. It's there as a safety net. I always say credit lines are good for a safety net or for short-term borrowings versus long-term borrowings.
Okay.
So you can use it, pay it off. Generally speaking, credit lines are going to be variable rate, where installment loan is going to be a fixed rate. So variable rate might be something, most loans are tied to prime rates. So Wall Street Journal prime rate plus a margin. So that can and will change over time. And we've had a rate rising environment over the last couple of years. So interest rates have increased dramatically. Whereas the fixed rates, generally speaking, are going to be lower than a credit line. because it's a one-time loan. It's fixed and locked in at the time you do the loan, and then it's going to be paid off over a period of time. That lessens the risk for the bank. Where a credit line, the risk stays out there a long period of time because we're giving you $10,000 access at any one time, whether we know your financial situation, 3 years from now.
Okay. Yeah, that's a good point. So in a fixed loan, you're looking at a snapshot of what my financial situation is today, and then you're making a decision whether or not to give me that loan because you know in advance how long it's going to take me to pay it back and what the interest rate is and how much I'm likely to be able to make those payments. But if you give me a line of credit and I lose my job 5 years from now, you can't possibly know that ahead of time. So that's why the interest rate tends to be higher, is what you're saying.
Yeah, generally speaking, that's absolutely correct, because what happens on a term loan is, you're paying it down, our risk goes down because your balance goes down over a period of time. Where if you have financial struggles over time, generally speaking on a credit line, most people are going to tap into those resources, maximize the amount they have borrowed out there. They might be using it to live on and things like that. So typically a bank's not going to find out that you're having financial problems until probably maxed out that credit line, and then all of a sudden you stop paying or you get past due. So that's when a bank knows that the risk is a lot higher, and that's why credit lines typically are riskier than term loans.
Okay. Yeah, and that's a good point. You don't realize, the bank doesn't realize that it's an issue until you've racked up a lot more debt on that credit line because you've basically maxed it out.
Most times a bank's not going to know until it's too late, because if it's too late for customer paying on their loan, generally speaking, they probably already have other bills that are past due too, whether it's their house, their car, other credit cards. So generally people pay their housing first, their car second, and then anything else after that. And you got to keep in mind, people still got to eat, buy groceries, pay insurance, and things like that.
Yeah. And I'd like to come back to the topic of debt here in a minute, but one of the questions that I wanted to sort of clarify, you mentioned that a line of credit is kind of like a credit card. So what's the difference?
Generally, I would say a credit card is good to have, especially for people to travel or have different things. But credit card interest rates are much higher than what a credit line interest rate at a bank is going to be. So flexibility of a credit card is you can use it at any kind of retailer or anything like that just by swiping the card or tapping the card, where a credit line is through your bank. You're going to get a set of checks, or you can do online transfers or stuff like that. It's going to have more than likely a much lower interest rate. So the credit line of the bank is still a good choice. It just offers a little less flexibility, where the credit card is generally accepted at any kind of retailer, where you can use it almost anywhere.
Yeah. And I would have to think too, with a line of credit at your bank, if you need access to cash, that's probably a better option than a cash advance on a credit card. Because I know with credit card companies, a lot of times your cash advance interest rate is even higher than your purchase interest rate. So is a credit line the same either way, whether you take out cash or whether you write one of those checks, it's the same interest rate?
It's the same interest rate. There's no fees for taking out any kind of a cash advance and things like that. So like a credit card, like you said, it's going to have a higher interest rate, and a lot of times it may have a fee that goes along with it, where a credit line at the bank, you're just going to be transferring your own money that you're already pre-approved for into your account. And it's not going to have any kind of fees on it. And it's going to have the same interest rate whether you write a check or you do an online transfer or transfer by any other mode.
Okay. So you mentioned, and I said I wanted to kind of go back on this, you mentioned about accumulating all that debt, right? And why the interest rates are a little bit different based on the different account types. So could we talk a minute about consolidation loans, right? You hear about that all the time. Like you can lower your debt and you can try to get out of debt with a consolidation loan. And it seems counterintuitive, I think, sometimes to people that why would I take on more debt to get out of debt?
You take on more debt to get out of debt because you can consolidate into a much lower interest rate. I typically like to tell people, if you're going to consolidate debt, do it into a term loan where you're going to have a fixed interest rate to pay it off. Because if you just put it into a credit line to extend it and maybe pay interest only, you're not doing yourself any kind of favor, because all you're doing is extending the time and the interest savings that you potentially would get. So you don't want to trade debt for debt where it's not being paid down over a period of time. People can go through and consolidate debt. If they do it responsibly, they're going to have a term loan, pay it off. Hopefully they use a credit line to more responsibly for short-term borrowing needs versus long-term.
Okay. So would you recommend, or does the bank normally recommend, that you close those other lines of credit when you do a consolidation loan? Or do you leave those out there because if those credit lines are still out there, you could theoretically continue to use them and then you wind up right back where you were?
It really depends on the customer and their situation and things like that. If people are just consolidating debt and they're not overwhelmed with debt, we may not require them to pay off and close those credit cards. But there's times where we do say, hey, you're coming in to pay all these debts off. You might be a marginal borrower. We might mandate that those credit cards are paid off and closed. Mm-hmm. If you're not, we may leave them open. In most time, people will let you know what kind of credit cards they want to do. I'm not opposed to having credit cards out there, but I think, generally speaking, if you have 2 or 3, that's plenty of capacity on a credit card, especially if you're traveling or making hotel reservations. You need a credit card for necessities. Most people do. Mm-hmm. Most people don't need 10, 12, 15 credit cards. And we see that every day in our business where very average, normal income people, working class people coming in with 10, 12, 15, 18 credit cards. And if you have that many credit cards, typically they're carrying balances of a few thousand, or we see people with 40, 50, 60,000 in credit card debt.
Wow.
So that's not an uncommon occurrence that we see on a day-to-day basis. So that's why we try to tend to, shift people into more secure debt, long-term debt. And I'm sure we're going to talk about home equity loans at a point here too.
So home equity, I think that goes to one of the first things we were sort of touched on. I think we kind of got away from was the idea of a secured loan versus an unsecured loan.
Right. An unsecured loan is just your signature, and we're hoping that you're going to pay us back on time, pay us off through the end of it. And if you have another financial need, you're coming back. Mm-hmm. A secured loan, could be against your own money. It could be a CD secured loan, could be an auto loan, or holding some type of piece of collateral. And the biggest kind of collateralized loan or secure loan is a home equity loan, where we're filing a mortgage or a lien against your house, as collateral. Mm-hmm. However, when you do that, you're going to get a much lower interest rate on any kind of borrowings, whether it's a credit line or a term loan. You're going to get a much lower fixed interest rate if you do it that way. And that's where we do a lot of consolidations, where we're using equity in your home, paying off on a term loan, paying off all those unsecured debts typically, to give you the savings and give you the access to that equity in the future.
So with something like a home equity loan, would you be looking at the average mortgage rate that's out there right now and then basing the home equity on that, or is it a different thing entirely?
Generally speaking, in a normalized rate environment, home equity rates are going to be slightly higher than what you would find on mortgage rates. However, currently, the market environment has been rapidly escalating for first mortgages. Mm-hmm. Home equity rates have actually been slightly lower than mortgage rates because what happens is you're taking a second lien typically on a home equity loan, so the risk is higher when you're taking a second mortgage against a house versus a first mortgage. And it all depends on the term. The shorter the term on a home equity loan, typically the lower the interest rate. Mm-hmm. If you go 3 years versus 10 or 15 years, the interest rate's going to be higher because the risk of that for the bank is a lot lower because you're going to pay off in 3 years versus 10 or 15 years is where the risk is.
So when it comes to home equity, you have to have equity in your home too, right? So you can't necessarily get a home equity loan if your mortgage is a year old, or could you?
Generally, no, you're not going to be able to get a home equity because I've had a lot of people over the years say, what do you call a no equity home equity? I call it an unsecured loan. So if you have no equity in your house, you cannot get a home equity loan. Most banks, including AmeriServ, might lend up to 85 to 90% of the value of their house, and then minus your first mortgage, and that's your lendable equity. So just in round numbers, if your house was worth $100,000 and say we're going to lend 90%, that's $90,000 minus whatever your first mortgage is. So if your first mortgage is $50,000, we can lend you $40,000. So that's just kind of the simple math behind it, where 90% of whatever the value is minus your mortgage is your lendable equity, what we potentially could lend you on a home equity loan. Now you have to qualify in a lot of other standards, whether you have good credit, your stability as in your job, your housing history, how much debt you have, what the ratio of debt is, how it's made up, and things like that. So there are a lot of factors that go into it.
Okay. So I think that's one of those terms that gets thrown around that maybe people don't always pick up on is equity, right? Because it sounds very, I don't know, mysterious, I think, to some people that don't have a banking background and stuff. And you say, oh, would you have equity in that? But equity is essentially what you have available on the piece of collateral you're putting up.
Yeah, I mean, true equity is just the value of anything, whether it's a house, a car, or anything physical. And if you owe anything against it, so it's the difference between the two.
Mm-hmm.
The lendable equity is, we're taking a little bit smaller factor. In a home equity, in our case, it's 90% of that value minus if you owe anything on it.
Mm-hmm.
And that's your lendable equity. So there is a little bit of a difference, but generally speaking, equity is just the difference between the value and anything that's owed.
Okay. And one of the other terms that you had mentioned earlier that I wanted to touch on too was marginal. You said that if the lender, not the lender, the applicant, the borrower, is marginal. What's marginal in terms of banking?
But those are the kind of things. A marginal borrower might be someone that has marginal or average credit, and they have too much of it. Another term we use is debt ratio. I don't know if you want to talk about that.
Yeah, absolutely.
I mean, a debt ratio is just simply, it's a gross monthly income. So whatever your income is before all taxes and, deductions are taken out, that's your income for the month. We take all your monthly bills, your housing payment, the new payment we're going to have on our loan, and any other credit card debt, student loans, any other kind of auto loans. All those monthly payments are added up, and then we divide it by your gross income to come up with a debt ratio. Mm-hmm. And most lenders out there on the consumer lending side of the house, are looking for somewhere in that 40% range, give or take, as being the high side. If it's over that, that probably means, you don't have enough money to live on. But here again, there's a lot of other factors that come into play.
So your gross income is obviously your payment before all your deductions, right?
Right.
And your net is after your taxes come out and after your maybe your health care is paid for by your employer, that comes out. Maybe you have a retirement saving that comes out. So why do banks use gross income rather than net?
The real answer comes down to it's a consistency thing. It's a way for everybody to be judged on a consistent basis, because your net income can be greatly changed by a lot of discretionary items, like what health care are you choosing? How much are you taking out for a 401k or any kind of retirement savings? Those kind of things can change. So if you have a lot of money going out to a 401k, technically you could reduce that to bring home more net income. So there's a lot of things that you can do on a discretionary basis that would be really minimize, what could be taken out there. So it's a way as a level playing field for all lenders to look at all borrowers on a similar basis versus looking at it from a discretionary side.
Okay, that makes sense. So really it's playing fair. With everybody.
It's playing fair with everybody from a gross standpoint, gross income, because the net income is your take-home pay.
Yeah.
And that might come into a decision where we look at how much take-home pay. When I talk about marginal, do you have excess disposable income? If you're marginal on your debt ratio, like we talked about a couple minutes ago, how much discretionary income do you have to pay utilities, to put food on the table, pay insurances, homeowners, auto insurance? So those are where your net income might come into play in the decision for a consumer loan.
Is there anything that is exempt from that you don't consider discretionary income, like something like, say, a cell phone, for example? Most people used to have a landline, right? And that was just you had the landline for the house, and that was considered pretty necessary. But a cell phone sort of bridges that gap, right? You have the necessary part of the phone, you have the unnecessary part of maybe having a smartphone with an unlimited data plan and things like that. So what kinds of things are considered in that calculation? What kinds of income or spending is not?
We're just taking any kind of debt, any kind of loan you have. So any kind of utility, cell phone, things like that, that's not included in the debt ratio. So that's why we use the gross income, as our calculation method. And we realize that people are going to have lots of other debts or bills that don't show up on a credit report that you got to pay for on a monthly basis.
Okay. I've heard of a lot of people, and I'm sure you have too, who come in and say, well, I've never had a loan, so I should have no trouble getting a loan, right? I don't have any debt, so I should have no trouble. Is that always true, or is it kind of one of those things where having no debt could end up actually hurting your chances of getting a loan?
You need to have some stability, and generally most lenders are going to want to have somebody co-sign with you or maybe ask for a secured kind of loan, depending on the situation. If you're maybe just starting out and have no history whatsoever, you're real short time on the job, you're probably going to need someone to co-sign or be a co-applicant on the loan to get you started. Once you illustrate that you can pay, a loan over a period of time, I personally like to see seasonality on a loan. Can you pay loan through 4 seasons? Because sometimes people make the mistakes of coming in and say, hey, I have no loan experience. They borrow and pay me back in 2 months. Well, you didn't really prove to me that you could pay me over a period of time. So the next time you come back, we're probably going to say, hey, we still need to have that same, kind of stability or someone else backing you on that. Generally, what I see the other side of it is people try to get, some credit cards, some loans. They go out and get 6, 7, 8 of them all at one time. So that's not good either. So it's a good balance to, take it kind of slow, maybe get a credit card, get a term loan, pay that term loan over a period of time, get some experience, and then you'll be able to do things on your own, from there on out, as long as you're responsible.
I think it's important to make the differentiation or to explain the difference between a co-signer and what their responsibilities or their liabilities are versus
co-applicant.
Co-applicant, yes, thank you.
Yeah, co-applicant versus a co-signer. A co-signer is obligated for the debt in general, where a co-applicant's, obligated for the monthly payments. So lenders typically like to see a co-applicant because if you're going on with somebody, you're obligated for that monthly payment. You're going to be much more aware earlier if there's an issue with repayment, where a co-signer might be a little bit late to the game, where they find out that the person they were trying to help out to get established not living up to their obligations. So, generally, most lenders like to see co-applicant versus co-signer. I've always said in my history, I've been doing this 32 years, is a co-signer or a co-applicant, if you're helping someone else, that's the strength of the, the loan. That's why you're making a loan, because of their strength. If somebody's not paying me, I'm going to them first, because that's why we made the loan.
Yeah. I think maybe some people don't always quite realize what they're signing on the dotted line for when it comes to that. And I think that's important if you're being asked to co-sign or co-apply for a loan, to understand that you're just as responsible for paying that loan back as the other person is.
Yeah, I mean, even 25 years ago, when I'd be face-to-face with customers, they had co-signers or co-applicants, I would be much stronger with the co-applicant saying, this is your responsibility to pay, because a lot of times, way back in my history, I would collect loans also. So you call a co-signer or a co-applicant, they're like, well, I need to sign my name so they could get the loan. I didn't really want to pay it back. We're like, well, that's why you signed your name. So we're coming after you for the payment. And if you don't perform your obligations, we're coming after you from a legal perspective.
So really, if we break it down, if your friend asked you to borrow money, right, you're most likely going to ask your friend, well, how are you going to pay me back? And you might ask your friend, well, have you ever borrowed money somewhere else, and did you pay them back? So it's in simpler terms, it's really just the idea that having no credit history means that we have no knowledge either for or against the idea that you could pay me back. We just don't know. And so that's why you usually ask for somebody to co-sign that does have a credit history, that you can say, okay, well, if you can't pay me back, this other person could.
I mean, lenders are always looking at there's lots of different, scenarios and acronyms out there, but the 4 C's of credit, whether credit history, collateral, capital, and character. So if you're borrowing from your friend, they know their character. What's the likelihood of Drew paying me back over a period of time if he comes to me and asks me for money? And we're looking at the same kind of thing, but we're looking at your work history, your credit history, your income. All those factors are taken into consideration, and what's the likelihood of you paying us back. So same thing as a family friend or something like that would be the same. But with a bank, you're going to get credit on a credit report, where the friend, you're not going to get any kind of credit for that.
Sure. So let's talk about a credit report, because we hear all the time about whether it's your credit card company or maybe it's Credit Karma or all these different places. They say, well, you can look at your credit score anytime. You can get it once a month, once a week, once a day. But what goes into a credit report?
Credit report's going to memorialize your history, your address history, any kind of work history, as long as lenders are putting it in whenever they're doing it, and any kind of loans or credit card history out there. Anytime you inquire for a loan. So if you go try to buy a car and they send it to 6 different banks, you're going to have 6 inquiries on there. So we're going to see, are you shopping for debt? Are you doing things like that? Not all credit reports or credit scores are equal. You hear you used Credit Karma and some of those, or different times customers come in and say my credit score is 950. Well, the banking industry typically uses the FICO score, Fair Isaac and Company FICO score. That's the most widely used by the banking industry. So that number goes from 450 to 850. So your highest credit score is 850. So when someone tells me they have a 928, I know they're using a credit score from a credit card or something like that. So it might be a good indicator that they might have good credit, but not all credit scores are made the same, and they don't have the same kind of scales. So credit score is really just an indicator on what's the likelihood of you paying us back on time. So it's not a be-all and end-all just because you have a high credit score. We're still going to look at your stability, your ability to repay. I mean, that's the big thing. Do you have the ability to pay us back based on our debt ratio, like we talked a little bit ago?
And are there different things you said about an inquiry? There are things such as soft inquiries and hard inquiries. What's the difference between those two kinds of things?
Hard inquiries, when you're going out to look for a loan or apply for a loan, there's going to be hard inquiries showing that, Drew, you applied for a loan at XYZ Bank last week, and then you come to us today to do an application. So we're going to see that you applied somewhere else, and we're going to question, what did you do there? Did you get another loan? Did you get turned down? What happened there? Soft inquiries typically for an existing account. You might be doing a credit line review. Any kind, we talked about credit lines earlier. We put them out, in certain kind of loans, like home equity loans, we review on a periodic basis just to make sure that your credit hasn't deteriorated. So there's only certain things we're looking at. But lenders always have a right to do a soft pull to see the performance of the loan, how it's being done, on a credit line kind of product.
So it kind of goes back to what we were talking about before. You can't do it all the time, but you're kind of testing the waters to see if somebody's getting in over their head before it's too late.
We definitely try to do it, but it's only on a periodic basis. So generally when you're doing those kind of reviews, if you see it, it's probably still too late because, it's already out there and people, are struggling. So, but it's like I said, when you go back to the credit scores, different variables we look at, I've always looked at credit scores just being an indicator, not a be-all and end-all. So you can have a 720 credit score, and that's on the average, above average side. But that doesn't mean you're going to get a loan. You might be overloaded with debt. You might have a 650, which is on the lower side. It might be just because of one small item might have hit it. You might have had a small collection account, a medical collection account, or cell phone, or those kind of things impact you, and those stay on your credit report for at least 7 years.
So getting into a little bit of the weeds with credit reports and credit scores, there are things that impact that score more than others. What are some of the ways that you could most effectively impact your score in the least amount of time? Like, what are the things that are most important when it comes to your credit score?
The most important thing is always pay all your debts on time. The other thing is don't take on too much debt. Don't be out there getting credit cards, every month and racking up things like that. The type of debt that you have and the availability of debts also comes into play. Do you have a lot of term loans versus credit cards and credit lines? Credit cards and the availability of what you have, can fluctuate on a day-to-day basis because you make big purchases, you might pay them off. Ultimately, a credit score comes down to a handful of factors, and everybody's credit score is different, and it can change on a day-to-day basis based on whether you bought more items, you paid things down. So like the FICO score is really based on the 4 most prevalent factors on your credit report, on your specific credit report. Yours is going to be different than mine, and yours could change on a day-to-day basis. So I always tell people, pay your debts on time, don't take too much out. You don't have to worry about what your credit score is. So a lot of times people get fixated on, they want an 800 credit score. And I'm one of those people, and sometimes I'm like, all right, if it's not 800 or over, if you're 798, you have no issues, no problem. At the end of the day, 798 is a very high credit score.
And there are 3 different primary credit score, I don't want to say providers, but I guess they are providers: Experian, TransUnion, and Equifax, right? And the credit scores could vary slightly between those 3.
Generally, they're going to vary between the 3. Most debts are going to show up on all 3, but you might have regional lenders or credit unions who only report to one of the 3, so that's where the differences can come up. Or if you have a collection or something that's more on a regional basis, certain credit reports are more prevalent, in certain areas.
So the idea that you should get your credit score from one of those 3 providers every year, like you can get your annual credit report, things like that, is that still something that people should consider doing?
I think it's a good idea to keep an eye on where you're at. If you stagger them, at least you can see if there's inconsistencies or any kind of potential fraud or something like that. If you stagger them, you're also going to be more aware of what your debt situation is. You're going to see that over the summer I've racked up a lot of debt here. So those kind of things, if you're going to do it, probably more on a staggered basis, that way you can see if there's anything unusual that sticks out to you, or maybe it's more self-awareness for your financial pictures, and build a budget on it.
Yeah.
Build a budget and financial awareness.
Yeah, and I don't want to get too far into it, but you actually mentioned fraud, and I think it's important to mention that too, that if you're noticing something on one of your credit reports that you didn't do, that's also a good thing to sort of keep an eye on, to make sure that you can report that if it's something that is out of the ordinary.
Yeah, if you see anything out of the ordinary, reach right out to whoever it is, a credit card or a lender, right away. If it's not yours, make sure you're reaching out to put a stop to it. And then put an alert on your credit report. You can reach out, and the credit reports are obligated to share with the other 2 credit reports. So if you do one, it does flow over to the other 2.
You can put a notification on your credit too, right? You can tell them that if they get anything, you can basically freeze your credit.
You can freeze your credit. You can put a statement on, if anybody inquires for credit, call me at X number, and they can put a time period on. A lot of times we'll see it where people will put it on for the next 12 or 18 months. If you see any kind of inquiry, you have to reach out to me to verify that I'm the one that applied for the loan. So we see it on a periodic basis, and we reach out to the customer, and then we're going to go through and verify that your identity for a couple qualifying questions that you would only know the answer to.
Okay. Keeping things on track with lending in this episode, I think it's important to spend a minute talking about repayment, because making your payments on time is obviously a huge part of your credit score and your credit report. But it is also something that I think people have a little bit of a misconception about when it comes to what the lender expects. The lender is not necessarily looking to collect on your collateral, right? I think it's in the best interest of the lender to have you make your payments on time. Is that right?
Yeah, banks are definitely not in the collection business. I mean, we collect loans, but we're not in the real estate or car business. We don't want your house. We don't want your car. We want to lend you money. We want you to pay us back. That's definitely something over a long period of time that, we want people to succeed. I've always said I've never made a bad loan. I've had good loans go bad, because if I felt you couldn't pay me back, there's an issue with the loan up front. So, of course, we've all had loans go bad. It's just the nature of the business. I've lent billions of dollars over the years, so it's just a matter of, you're going to have people that have come on hard times. They lose their job. They're laid off. There's a sickness. But at the end of the day, we want you to succeed. We want you to pay back. And banks are going to work with you, to pay back. They're not just going to come in and, repossess your car, foreclosing your house. I mean, there's going to be a long period of time, and you're really trying to work with you to get back on track.
Yeah, I think that's definitely something that people at times, I think, have this misconception that the bank is just out to try to take whatever they can take. And the end of the day, it goes back to what we started talking about, which was, I mean, yes, we are in business to make a profit. I mean, we are a business ourselves, but we're basically in business to help our communities, to help the people that need the money to open their first business, to buy their first car, to get their student loan, whatever it might be.
And you're going to take a loss. Anytime you repossess something, you're going to take a loss on, no matter what the value is or what they owe, you're taking a loss on something like that. So, yeah, my job is to take our deposit money, lend it out, and you said it correctly, is We want those people to pay us back, come back the next time they have a need. So we want to be their partner for life. I mean, I know it's one of our slogan or our taglines, but we want to lend money to people when they need it. And when they come back, we want to be able to, lend them money again.
Yeah, absolutely. The only thing that I don't think we really touched on much, and I don't know how much you want to get into this, is calculating interest on a loan.
From a lending standpoint, you're going to use simple interest. It's simple daily interest. So all loans are based on the amount, your dollar outstanding balance, based on your daily interest rate. So it's really just taking your decimal point out 2 points. Say it's a 7% interest rate. So 0.07 is 7%. And if you divide it by 365, you get a daily interest factor, multiply it by the balance, and that's how much interest on a daily basis. So whether it's a credit card or credit line or a term loan, your interest is always going to be calculated on the balance outstanding, however many days in a period between, the last payment and this payment. It's a little different for credit lines because credit lines are based on a prior period. Just think about the credit card analogy I used earlier. You're always paying on a prior period. So that prior period credit line works just the same way a credit card does, is they're going to find out what was your balance on every day and what interest rate was established for those days. If there was a change in interest rate, it might be different. And every day is going to have what your daily interest is. You add it up, that's how much interest you're going to be charged.
Okay.
On a term loan, it's going to be the number of days between the payments. So your interest paid from your last payment to the next one. So if it's every 30 days automatically, you're going to see your interest go down just a tick, a little bit here and there. You might pay 25 days the next month, and then you might go 35 to the next one. You'll see a little difference in it. But the days of pre-computed interest, that changed a long time ago, where you were paying top-heavy interest. Everything today is based on simple interest and a daily interest factor.
So if I have that right, because sometimes we'll say, well, I want to pay off my loan early. I need to get my loan payoff. So what you're doing when you ask for that loan payoff is the bank is calculating what you have remaining on the loan, and then the difference between your last payment and whatever date you're trying to make the payoff to calculate the daily interest that would have been added because you haven't reached your next payment date yet.
Correct.
Okay.
So, a long time ago, where there was interest, where it's pre-computed interest, and you were paying higher interest cost on a monthly basis up front, the earlier in the loan versus the back end of the loan. So when it changed to simple daily interest, you're not being penalized. You pay it off. It's only based on the interest that you've accumulated from your last payment or your last statement to the day of payoff. Okay. You might hear the term per diem. Per diem is just the daily interest rate or the daily interest calculation, how much interest you need. So if your payoff today, Drew, is $5,240 and a per diem of $1.20, if you pay it off tomorrow, you add $1.20. And then each day after that, because your balance hasn't moved, so that's how much your interest is on a daily basis until you pay us off.
Okay. And that's why you can't really use that same formula with a credit card, because you could change your balance on that credit card several times a day if you really think about it.
You could change your balance on a credit card, or interest rates could change, prime rate could change, or whatever the index you use could change mid-cycle. So, it's a little bit different on a credit card where you can't use like you would on a term installment loan.
So you had mentioned before, and you just did it again, about the Wall Street prime rate. Can you explain a little bit about what that is and why banks use that as the rate of choice or their benchmark rate?
It's a widely used index. It's based on various economic factors, and it's a consistent factor out there. So you got your interest rate, and then everybody would add a margin, which is the difference, what you're charging over prime rate. So it depends if it's a secured or unsecured loan, how big that margin might be. Like a home equity loan, most lenders are at prime rate. So if you use a credit line, a home equity credit line, you might be paying prime rate, which today is 8.5%. So that's dramatically climbed over the last couple of years. What you were paying 3.5%, 4% 2 years ago is now 8.5%. So that's why I always say a credit line should be used for short-term borrowings versus long-term. But if it's an unsecured loan, it's going to be paid, you're going to pay maybe 3% over, 4 or 5% over prime rate.
Okay. So it's essentially a starting point for every bank in the U.S., and then they kind of take in other factors, regional factors, your particular factors, and then calculate an interest rate off of that.
Yeah, I mean, generally that's what's happening out there. There are other indexes that banks may use, but prime rate is the most widely used, I would say, out there.
Mm-hmm. Okay. Well, I thank you very much for doing this with us. I mean, it's a lot of really great information, and we could easily go much, much deeper into a lot of these topics, and I'm sure that we will at some point, but I think this gives people a good overview of what it is involved in doing a simple bank loan that you might need. And you can use bank loans for just about anything. When you come to your bank and you ask for a loan, does the purpose of the loan get calculated into your decision as to whether or not you grant it? Or can you use a loan for a vacation as easily as giving your son or daughter a wedding?
It really depends on what the factors are using, the debt ratio and things like that, because we see people use it for home improvements, vacations, weddings, education, debt consolidation. If you're consolidating debt, we want to know what debt you're going to pay off. If you're paying those debts off, we're not going to include that in your debt ratio. That might mean the difference between you qualifying and not qualifying. So various things we see people use, but if you're highly qualified and you're coming in for a smaller dollar amount, it probably doesn't matter what the purpose is. If you're marginal and you're on the cut line of where we say, hey, we're comfortable or not, and a lot of times we have applications come in and it doesn't say what the purpose is. Say you're denied because you got too much debt, and then all of a sudden, well, they wanted to pay off these 6 credit cards and all this stuff. I'm like, well, if we knew that, we would have calculated different. Then obviously we go back and recalculate and say, okay, Drew, now you qualify because you want to pay off all these debts. So there's a lot of different things in there. So we always want to know the purpose. It's not because we're being nosy, because we're trying to make sure we don't calculate things that we shouldn't calculate into the ratios.
Okay. Yeah, that makes sense. Okay. So thank you very much. I hope you enjoyed visiting with us today. I mean,
I definitely enjoyed it, Drew. I appreciate your time. And thanks for asking me to do this.
Absolutely. Thank you very much. AmeriServ presents Bank Chats. This podcast focuses on having valuable conversations on various topics relating to banking and financial health. The podcast is grounded in having open conversations with professionals and experts to help take some of the mystery out of financial topics. We live our lives using bank products and credit products, mortgages, auto loans, credit cards, but many of us don't always understand what we're getting ourselves into. Please keep in mind that the information in this podcast and any resources available for download from our website or other sources relating to bank chats is not intended and should not be understood or interpreted as financial advice. We expressly recommend that you seek advice from a trusted financial professional before making financial decisions. Drew Thomas is not an attorney, accountant, or financial advisor, and the program is simply intended as one source of information. We are not a substitute for our financial professional who is aware of the facts and circumstances of your individual situation. Thank you for listening. Before you go, we want to once again thank Rusty Flynn of AmeriServ Financial's lending division for joining us on the podcast today. If you have questions about the discussion or would like additional information, you can visit us at ameriserv.com/bankchats or leave us a comment. We look forward to hearing your thoughts about the show. AmeriServ Presents Bank Chats is produced by AmeriServ Financial Incorporated. Music by Rattlesnake, Milo, and Andrew Kalitkin. Production assistance by Jeffrey Matavish. Please check out our full library of episodes, which can be found on the AmeriServ.com website. You can also download or stream the podcast from your favorite podcast app. For now, I'm Drew Thomas. So long.